All right. Good morning. Good morning, everybody. Monday. So this is going to be a little short week. Um, there won't be a half day of trading Friday. It's just going to be Monday through Thursday. Friday, we're closed. There's there's going to be a general lack of real participation, and yet I was reading on the blog of the Goldman Sachs blog, and it sounds like a lot of people are going to be working from home anyways, or I should say they already are working from home, right? A lot of those institutions, those guys have transitioned to being at home. Um, they're going to be trading anyways. They're looking to get a lot done this week. So there will be some participation, unlike, say a couple of years ago when the institutions were not working from home. As I posted in the large caps, the 10 a.m. leading indicator is the real economic one for the day. It is important to recognize the additional auctions at 11:30 because this can start a trend or kill a trend if we already had one through the morning. The algos are doing pretty good. We can see how the S&P has been coming up off of those lows. We were down more than 1% when we opened in Globex last night. So, a little bit of recovery. So keep your eye 10 o'clock and 11:30. Those are the two main ones. All right, down 1.1 at its lows. We were down 2%. So, we've come up off of those a little bit. This very clean price action is indicative of algos, likely not US algos. So we got this very ugly muted inverse head and shoulders. Almost no left shoulder there at all. That'll tie us back in to this price shelf here, right around that 45.90. That would complete the measurement from down here. If we look at a micro cup and handle from 45.70, that put us back up to 46.20, which would basically get us back to where we closed Friday. So you can see it's on the table. The measurements are there. It's worth noting the level of volatility in the market, right? It's something we talk about all the time. So we have the weekly expected move. Now, this indicator is really just getting the number from over here. All right. So it's not calculating anything. It's not measuring anything. It's just taking this number and then plotting it out. The difference, though, is that this number continues to move and change and update throughout the trading week. These lines were locked into place Friday, and they don't move now, right? So they're static, not dynamic. They don't update. Throughout the trading week, you can refer back into here and ask the question, has the expected move continued to decrease the way it's supposed to? and it should decrease, right? Because it's measuring, for an example, 3 days. Tomorrow, it should be a smaller number because there's only going to be 2 days left, right? So it kind of makes sense. For today, for an example, we have a 0 day today. The S&P has an expected move higher or lower of $42. And I usually say the word or, but it's supposed to be and or, because it really could go $42 lower and then go $42 higher, or vice versa, right? So you can see that we hit the edge of the weekly expected move last night, 45.25. That was how far the market was expected to move in an entire week, and it did it in a Globex session. Another thing to note while we're out here is the size. So this is last week's expected move. It encompassed 5 trading days. The new week that we're looking at only has 4 trading days because we're not going to be here Friday. And yet it has a projection of more volatility than we had last week. So less time, bigger move. That's what they're telling us here with this increase in volatility, that they're expecting a lot of fireworks. Just keep that in mind throughout the trading week, right? All right, so we've got this shallow area here. We're very likely to move through shallow areas very quickly. There's not a lot of volume nodes there to deal with. Should we be able to get through those, then we're likely to see some resistance near the open, or near the close of Friday, either way you want to say it. It's an institutional pivot point anyways, so it should be on your radar. Another way that you could say it is it'll be yesterday's low, right? That'd be a good way to focus on it. First touch on yesterday's low will be a great short opportunity. I wouldn't expect a lot out of it. I was checking first touch this morning in the Nasdaq and was hitting about a 1-to-1. It's not bad. So at least, you got an opportunity there. An upside move, we're already down more than 1% still. An upside move could give us back our 1%, get near flat. If we get above yesterday's lowest point, I really can't see that we're going to make it above yesterday's highest point. And I'm talking RTH high, not Globex. I don't see that we have it in us to make it through that unless we get some really good news on the leading indicators. Unlikely, right? Goldman cut their forecast for next year GDP because of the whole Build Back Better plan crashing and burning yesterday live on TV, and the White House freaking out and getting mad about betrayal and reversal and whatever, politics as usual. But when Manchin did that yesterday, he basically just wiped out all of the all of the work, I guess that's a good word, that the institutions have been doing, they price in things like that, right? And there's supposed to be this uh, monetary policy and fiscal policies coming out with the passage of the Build Back Better that was going to seriously impact 2022's economic outlook. And of course, they always get ahead of the game. They've been trading into the things that would benefit from that Build Back Better plan. Well, they're going to have to unwind all of that now. So, we'll be looking for capital rotation on that front, but then also the target on the year. So I often talk about the S&P target from last January, from 2021, was 5,000. And when we were sitting way back here last January, and I was talking about 5,000, there were a lot of skeptics. Oh, we're not going to go that far. Yeah, well, we didn't, but we darn sure got close, right? That's 1,000-point move from 38 to 48. This next year is what Goldman revised. How far can we go in the next 12 months? That revision is going to shake the market. Maybe not this week, but as we come into the new year. So, the futures, we're trading in the March series contracts right now. They're going to be the ones the most impacted, immediately impacted by this change in sentiment and the capital rotation. If things get worse, a move to the downside, we've already covered the weekly expected move to the downside. I would be looking for an additional standard deviation beyond that. If we have an expected move of $40, so take 45.60 and subtract $40. That would put us at 45.20. Then take even more off of that. Because if we're looking for an outsized move, then we would expect maybe like a market maker move to be priced in. We don't have a market maker move yet on the ES. We don't have one on the Nasdaq. On any of them yet. I would price in a $60 move instead of a $40 move if things start to get really negative. For the Nasdaq, we really don't have much of a quote shallow area, mainly because we're still building a volume node here in the profile. This is a shallow area because it actually has depth on each side. Here it's just decline. But we should be able to move back through that reasonably well. It just won't be like up here where we move, one or two candles extreme distances. Look at that very large shallow area. A lot of resistance right around the 775 area. It will be a real chore to get through that. And it would likely be based on some kind of news. I don't think the leading economic indicators would push us through that. We don't have enough of a base here for a failed flag yet. I'd be looking for some indication of that. For today, the Nasdaq still has $188 expected move to the upside or downside. That's a significant move. It's another 1.25% move up or down. So the Nasdaq at this point is projected to get back to zero or add an additional 1.5 to the downside. It already was down 2%. Should we reclaim those lows, we'll be using the Fibonacci for our downside targets. We got to bring in some more chart. All right, so we're at a critical level here. If we break through that, then 15.4 is going to be the next stopping point. We'd be looking for first touch rebound on 15.4. I'd aim for at least 25% recovery on that first touch play. That's not bad. So you're talking about going from 15.6 to 15.4, and it's 200 points. Take 25% of that as your upside move on your first bounce to the downside. Right? So what we're talking about is a market that comes down, bounces, and comes back up about 25% before either retesting that low or building a base, flagging and breaking through. Just talking about this first touch and how far on the bounce it could make, right? So 15.4 and a pullback to the upside. For the weekly expected move, this is last week's weekly expected move. It had 5 days in it. This is this week's expected move, and it only has 4 days in it. It's a bigger box with less days, signaling or implying that volatility has gone up. Now, the Nasdaq has a habit of, when it really gets out of the box, not like this. This is where it got out of the box, but it really didn't get too bad. If you take the midpoint to the low of the weekly expected move and you plot that from the low down like this, if it breaches that, then we're likely to get, say, a 3 sigma move. Add, say, a couple more standard deviations, it gets really bad, right? The Nasdaq is just one of those markets that can really make moves, right? So depending on how many days are left in the week when we break out of that range, it can really get violent. And it comes down to the algos that are trading these lines. More on the S&P when it comes to algos and those lines, but a lot of the names that are in the Nasdaq are also in the S&P. So those algos, if we break to the upside, they have to buy to get delta neutral. So the more we go up, the more they buy, the more they buy, the more they drive us up. And it causes a vicious loop. Well, it's the same thing to the downside. If we break and breach below the expected move, they have to sell to get to delta neutral to hedge their positions. So they're selling contracts to hedge. But the more they sell, the more they drive us down because of their selling. And again, it becomes a vicious loop. It all ends at the end of the week and resets. But, depending on how early in the week the break comes, it can get pretty violent. It's what they call a volatility box. So keep your eye on the weekly expected move. If there is going to be any kind of troubles, that's likely where it's going to start. An upside move, if things start to actually turn around, say, the leading indicators are in some way positive, we could expect to reclaim the negative move that we've made, the 1.3% to the downside. We could likely see that turned around. That would get us back to where we opened in the Globex. And I would not look to make it through yesterday's high without some news that gets us there, right? It won't be sneaky. It won't be subtle. It won't be a slow grind. If we're going to hit these values, it's going to be everything lit up. Tick, trend, AD, it'll all be firing. There is the third bit of analysis that says we just stay range bound. We've set a low, we've got our high. We could very likely just spend the rest of the day right there. I really don't see it though. There's a lot of really big names that are up on the year significantly. Talking about change percent on the year. A lot of the institutions or fund managers are going to be looking to settle the books at the end of the year. We're looking at a serious capital rotation now with what Manchin did. It could really start to get ugly out there. So that whole logic of, it's gone too far. I don't want to get in now. No way it can go farther. And of course, you sit on the side and you watch it as it just continues to go and go and go without you until finally you can't take it anymore and you get in. And of course, that's when it finally reverses. Don't get caught in that today. So you can see the bonds are kind of shaking things up a little bit. We did have that big move in the dollar Friday, but it's kind of calmed back down since then. We don't want to see big moves in either one of these two markets. The indexes are moving relatively in sync at the moment. That's not necessarily a good thing. A synchronized market is a more dangerous market. It can move a lot farther. The dollar is still not a representation of global risk at the moment. It doesn't look anything like the VIX. Earlier this morning, I seen the bonds and the indexes moving in the same direction at the same time. They were all green and then they were all red. So, there's just a whole lot going on out there. And one of the best indicators that you can use is price action. the more price that you look at, the more markets that you look at, the better understanding you're going to have of whatever it is that you trade. One thing to keep in mind is, why are we down this morning, right? When Boeing had uh, problems with its airplane, right? It was literally killing entire families of people. Its stock went down. And we could look at it and we could say, well, Boeing went down because they had these real serious issues with their plane. Why is our market down this morning? Just sentiment. That's all, right? It's just sentiment. The Omicron situation, um, they said, yeah, it is more easily transmitted, but the impact, or the health impact, the other side of it, once you get it, it's not as severe. So the transmission of it has caused some lockdown, some talk of lockdown, border controls. It's affecting, shipping rates, and there is an impact, but nothing extreme. So sentiment on that one. And then the whole build back better getting tossed in the trash. That one, it does actually have some weight behind it, but that wasn't the only policy that they were looking to do. And there is talk already of a more muted version of build back better. So, there are some opportunities still for a different economic package. It may not be as big, or, it may not inspire such confidence. But for the most part, our market is down this morning because they don't have that warm, fuzzy feeling, right? So don't go out and start shorting the entire marketplace on a whim, or with some bearish, deep bearish bias. I wouldn't be holding a deep bearish bias. Short duration trades, and be ready to flip and take the other side. All right, so we got the S&P 500. I'm going to change this to pre-market change percent. We want to use the filter to reduce this to about 100 names. I've been having a hard time getting even remotely close to 100 lately. 92 is about as good as I can get. And it's just because of how many names right now have a market cap between 92 and 118. So it'll have to be 92. We'll change the color scheme to get rid of the gray area as much as possible. And I think that really says it all right there. Now, I'm a big believer in the idea that when we have the sectors to use, I want to use them. They are the biggest names in their industry that make up those sectors, right? If we were looking at, health technology, we would look at the biggest market weight names in that sector. But on days where we can't lean on the sectors, then we want to be stock pickers. We want to use our own scanners and watch lists and focus on whatever's moving to meet our trade criteria. For me, that's, 5-minute open range breakouts, inside day breakouts, red to greens, trend line breakovers. But I'd still need a list to trade from. That would be names that have weekly options. So we're not going to be really leaning on the sectors unless the sectors start to turn around. We've seen that a little bit Friday, right? We had more and more names turning green through the earlier part of the day. Keep your eye on those sectors. They're just a nice little bellwether on the day. There are almost no names this morning in the S&P that are up, at least 0.5%. And the ones that are, kind of are attached to some news. Change this over to the Nasdaq. Pre-market change percent. We don't need a filter because this is the Nasdaq 100. We'll just change the color scheme a little bit. So you can see communication services has a couple of names, right? And healthcare technology, a couple of names, nothing looking really good. The Fang names really stand out. Google, Microsoft, Apple, Amazon, Netflix, Tesla, Nvidia, Facebook, right? Out of all of those, most of them are deep red. The Fang names are enough to wipe out an entire market, right? This is where our market breadth studies get confused when we see, you know, 80% of the S&P moving to the downside, and then we see the SPY or the ES going up. How? Well, because 80% of the S&P 100 can't compete with the 5 biggest names in the S&P. So if those 5 are doing good and the entire rest of the market is doing bad, it's still going to go up. Same thing the other way around. If those 5 are doing bad, their other 80 could be good and it would still drag us down. So how many names in the S&P are down at least 1%? 44 names. So saying it another way, 45% of the S&P is down at least 1% this morning. That's feeling pretty negative out there. You know, when we see a lot of red on the screen, a lot of times that can be misleading because it may only be down, say, 0.25%, right? So it's not really negative at all. It's just slightly down. But this isn't slightly down. This is down more than 1%. Ask the same question in the Nasdaq. 40 40% of the Nasdaq is down more than 1%. I can't scan with these. It will only let me do its own indexes, but weekly options companies, man, even these. So normally when we come over to companies that have weekly options, even on a negative day, this is a watch list with 600 names. Generally speaking, even on a bad day out there, we have at least 50 to 75 names that are up, you know, at least 0.5%. We don't have that this morning. We don't even have 20 names total that are flat or green, let alone up at least 0.5%. So the negativity that we see out there isn't just in the sectors or in the S&P 100 and the Nasdaq 100. It's across the board. Now, I built that watch list by using the scan in Thinkorswim. Just scan weeklies, and you know you can add your own criteria if you want to. If we just want a list of names that have weekly options, then I don't want to, you know, add any other criteria, but I do want to remove some things. So for an example, all ETFs, right? If I want to look at SPY or QQQ, I don't need this thing. We're looking for companies with weekly options. So we just want to exclude all ETFs. $527 names have weekly options. Now, from this list of 527 names, this would be the scan list that we then start using to filter down our opportunities, because obviously it's too many names. Maybe cost would be one of your criteria, or you know, the distinction of a market sitting near its 52-week high and a market sitting near its 52-week low, right? If you were to eliminate anything sitting near its 52-week low and reduce the list even more. Filtering by sector or industry would be another way to reduce this list. I have them sorted by market cap. Now, Thinkorswim doesn't give us a change pre-market, right? We can't do it that way. There's a little bit of a modified indicator that will do change in the pre-market, but that's why I use, TradingView or TrendSpider, because we don't have to trick it to show us pre-market change percent. But these are the weekly names that are on that list, right? That's where this list comes from. And we can see that there's just nothing out there, right? But we're going to be looking at this list for a turnaround, especially some of these names that aren't down very much. We really want to see which industry or which sector, if there is any, that starts to turn around. Because the S&P, when we talk about sectors and industries, the S&P is an old index. There isn't a pot index, for an example. You can look at energy, you can look at finance, technology, building materials, healthcare, utilities. You don't have an EV market, electric vehicles. You don't have a blockchain market or a pot market. So we make those, right? We build those on our own. I would be checking all of those. Now, generally speaking, I use TrendSpider for that. Mainly because I put those lists in there, and TrendSpider does a really good job of working with pre-market data. It also has built-in analyst upgrades, analyst downgrades, analyst recommendations. Those are all built into it. What's the matter with TrendSpider? There we go. So the weekly options list, same as before. Now, see, that's showing a completely different thing. It really makes me wonder what's going on here. Because this isn't showing very many names. But this is. See if Zoom is still up. One of these is not right. Either TrendSpider or TradingView. That looks like it's up in the pre-market to me. Just randomly picking names to see if, yeah, that's accurate too. I would say that TradingView was off this morning. That there was something wrong with TradingView, because look at all these names that are up. And I'm not going to sit here and check every single one of them, but when I can just randomly pick a name and find that, yep, it is up, in the pre-market. Now, I will say that sometimes what it's looking at here on this change percent happens to be from the after hours. Say we're looking at it Thursday morning. On Wednesday, after the market had closed, a market makes a big move, a 2% move, and this quote after hours change is nothing more than what happened after 4 and before 8 o'clock at night. So then in the next morning, it's not moving, it's not up anymore, but it'll be showing that it's up. That happens on a lot of different platforms, not just say TrendSpider or TradingView, but a lot of even Benzinga Pro will do that. Because it's not making a distinction between after hours and pre-market. It's only making a distinction between regular trading hours and not regular trading hours. But this would be the list that I would use to find opportunity. things with weekly options that are up in the morning, and then try to put them together by their sector or their industry. Blockchain names are down significantly. Electric vehicles market also down. Nothing there. And the pot stocks are down. So I bring those up only because, as I mentioned, there is no S&P sector to cover those kind of names. Thinkorswim has a built-in watch list called sector indexes and sectors and industries. So you can go in and kind of get an idea of what industries and what sectors it does have. And yeah, they're written in S&P language because it's old school stuff. But just click on it and it'll tell you its name up there. So, S&P 500 10 is energy. 15 is materials, right? Like that. These names or these sectors are old school legacy. Yeah, that works. Just turn its symbol off and look at it from description. Then you can see. I wouldn't even have the last on there. There we go. Energy, materials, industrials, blah, blah, blah. Right on down the list. So what I got for you guys. Be careful, be safe. We'll be streaming in the large caps this morning. We'll do what we do, I guess. I don't know which direction we're going to go or what we're going to focus on. It is a 0 day, so we always have those. But nothing is really standing out yet. Maybe a good opportunity to just do some learning stuff instead of some trading. I don't know. I'd rather get a trade on. But either way, I'll see you guys there.